Small cap index is higher at this point as well. So that is the overall picture. 1450 stocks are higher, about 1,000 stocks are lower at this point in time. So Nifty heat map quickly gives you a sense of where things lie before we go any further. So how many up and down will come up on your screens. I think IT is opening up in a decent way. I can spot a few of those names right there at the bottom of the screen. Okay, I think...
There's, by the way, while we talk about large caps, look at Urban Company. It's servicing the shareholders very well. 3.5% up again on Urban Company after yesterday's big start. Okay, now it seems to have cooled off. But yeah, maybe we can get the rates from both the exchanges. Yeah, now it's cooling off, 2% on Urban Company. Anyway, large cap, the leadership is all IT. This Fed rate cut has really inspired sentiment, it seems. Infosys, Wipro, HCL Tech. One narrative, remember, is that eventually with lower rates in the US, people will get back to more discretionary spends, the regular spends, even as the AI juggernaut continues along. And that at least sentimentally seems to be helping. So between 1% to 2% up on all large cap IT. Then you have financials, which are firing. So, that's turbo engines, twin engines firing, both IT and banks. HDFC Bank, ICICI Bank, 0.5% to 0.7% on the higher side. Then what else? There's Eternal, there's ITC from the consumer space. Yesterday, some of the metal stocks were weak. Today, they're at least starting out on an optimistic note. I saw Tata Steel flash by, but it's flattening out now. Reliance is up 0.25%. So that's how we are positioned, at least at this point in time. Sun Pharma, the stock that Sud was talking about with that city positive view, it's starting off with a gain of about 0.5%. Now, on the downside, you've got Hindalco, which is lower. There's Bajaj Finance, SBI Life, State Bank of India itself, which is down about 0.25%. So those are your key losers. Life insurance companies still lower. And there's Apollo Hospitals, Reddy's and Cipla. So healthcare and pharma, not very hot, but IT surely is. Nigel.
Well, that's right. The index that we highlighted in the morning that could potentially react to this Fed rate cut was the IT space. And that, in fact, is the outperformer today. That's up close to around 1%. So big move is what we're seeing on that index. The other one that we've spotted earlier this morning was HFCL. And we gave you a hint last evening itself towards the end of trade. That could be one of the stocks that's coming out of the F&O band. So we're seeing some kind of action out there. Volumes as well, rather high on that one. Besides that, IRM Energy, that stock has moved on very, very high volumes. I'm not sure if there is any news out there, but solid move is what we're seeing on that stock. Big uptake in initial trade itself. A few more notable movers. Cohance, as should be mentioned, I think, that block is out of the way. Stock is down 5%. Volumes very, very high. Sometimes it's interesting to see the stock post the block getting out of the way. So let's see whether or not there is some more action. Reddington, after a big surge, is still up close to 18% in this week. It's cooling off a breath a little bit this morning, though. A few more notable movers. You have KNR Constructions, unusually high volumes out there. That's up close to 2.5%. Urban Companies holding on to a 2% gain. And Sagility, that's the other stock that's up and about in today's trading session. A quick word on Hindalco. There was a fire at one of their units, at Novelis itself. And the stock is a little under pressure, because the Oswego plant, which is, has a capacity of roughly around 400,000 odd, which will effectively mean close to around 10% of Hindalco's total capacity. And more importantly, bulk of their capacity is toward the automotive space, which is high margin business. So you could expect some pressure for the remainder of this quarter, if in case the plant doesn't reopen. That's a stock to track.
Absolutely. By the way, we are now up a clean 1,000 points. This is the 14th day from that low on the Nifty. 24,400 was the low, and 25,500 is now 25,400 is now on the screen. So that's a 1,000-point move. Number one volume-led gainer is Urban Company. It's up back up 4%. So 173 there. Lots of interest, of course. Zentech is coming up as the third largest volume gainer. It's up 5%. Limit up, I think, for the day. 1621 on Zentech. On your screen. And what else? Heritage Foods is up 3%. Ismo is up about 4%. $1,000 on this one. IZMO. Escorts is up 2%. Subros is up 4%. Saregama is up 3%. So yeah, I mean, this is still very early in the morning, but lots of stuff with volumes moving. And moving in a good way. Tega is down about 2.5%. Stocks at about 2,060, but it's up 30% for the year still, although it's just a little bit off the highs, basically. DCM Shriram is coming up with the 3.33% of a cut right now, 13.35, and Aether is down about 1.5%. MobiKwik is another one which had such a sharp move, so it's coming off a little bit from the highs at this point in time. So that's where we stand. Let's welcome in our market march of the day. Sunil Kaul is Global Emerging Markets Equity Strategist at Goldman Sachs. Sunil, good morning. Great to have you with us here. Good to have you back on the program, back on the channel. Sunil, let's just maybe start by looking at things through the lens of markets, from a market perspective. Do you think we are set for new all-time highs shortly? I mean, as some are saying, by Diwali. And maybe there are bigger gains in store. I mean, these things creep up on us, and before you know it, I mean, we're already up, as I was saying, about 1,000 points on the Nifty in the last 14 days. What's your sense? It's a slightly near-term question, Diwali and maybe by the end of the year, but what's your sense?
Look, Prashant, I mean, I'm not sure about Diwali or year-end, but look, I think we do expect further upside in equity markets in generally, including in India. I would say, I mean, obviously, we just had the Fed rate cut, but in general, if you sort of look at the global backdrop right now, you're kind of looking at U.S. economy slowing, but avoiding any outright recession. You're kind of seeing Fed cutting rates. We think they will do more, 2 more rate cuts this year, another 2 next year. So still more rate cuts to come, which means many of the EM central banks will continue to have some room to ease policy more. You got a dollar which has been weakening, and we think will further weaken from here in. So the setup is one wherein it should be generally pro-risk, right? Weaker dollar, rates being cut, growth kind of holding up in many places. And so that people should be continuing to take risk in EM markets. And that's why EM, for example, is more than 20% up year to date. And we think investors will continue to take allocations in the EM equity markets, and that continues to play out. And in that, we think India will also benefit. And so we do expect markets to go higher. We do have a 27,000 target on Nifty on a 12-month basis, which from current level is still sort of mid-single to high single-digit gains. Whether that comes in a shorter period of time by year-end or Diwali, we'll need to see. But overall, I think given the macro setup, we think markets should still go higher from here.
Yeah, Sunil, hi, good morning. Great to have you in. I was thinking you'll sound even more optimistic because I was going back to our old conversation and I remember, and this was before the 15th of August speech and before the announcement of the GST cuts. And we were really, really optimistic on the second half. And you'd given us that target, 27,000 in the next 12 months. So I thought today you will, either increase that target or shorten the time duration because now we have the GST bonanza as well. But still, on that comparison scale, still tempered. But tell us, I mean, your call on consumption spot on. But now how much more? Because stocks have also run up quite a bit since we last spoke.
No, I think that's a great question, Surbhi. Look, I think as you recall from the previous conversation, we were expecting a recovery in the consumption. We were already seeing a rural recovery coming through. And on top of that, you got the GST cuts, which I think means that consumption should be recovering in the next couple of quarters. And so we were, even before the GST cuts, we were kind of positioned that way in the market in the sense that we were overweight the consumption pockets and we continue to hold those views. I've been sort of running around in Asia, speaking to clients this week and part of last week. And I would say the consistent feedback around India has been that growth has been coming back, but it's still very concentrated in consumption rather than the rest of the pockets. And that's kind of our view as well. And there has been more going on in the rest of the EM pack, which is where the action has been. And obviously people are quite excited about the AI story. And you got the North Asian markets and China to play that. There have been sort of more catalysts in the rest of the EM in terms of corporate reform story in Korea, more excitement around Europe and the markets in there. And so I think the general feedback has been that India doesn't play into the AI story. You have consumption coming up, but you haven't seen much pickup in the credit growth. You haven't seen sort of IT obviously today is doing well, but it's still a US sensitive sector. And in the case that US growth is still slowing, It has come off in the last year, but people are still a little bit reluctant to take exposure there. And then given government has been consolidating on fiscal and they have given the consumption boost, the general sense is that they might moderate the infrastructure spending. And so you go through the sectors, it just feels like consumption is the bright spot, which we agree and we are positioned there. But the other sectors might take a little bit more time, which is why the upsides is more kind of moderate in our estimates.
Sure. Sunil, so I'm just trying to understand that incrementally, when you map earnings now, overall for the market, for the wider index, or even for, let's say, consumption companies, where are you at? And have those estimates been bumped up after the GST cut? Some ranges or numbers would help here.
Yeah, I mean, that's a great question, Surabhi. So I think we have, I mean, obviously the second quarter reporting season was generally pretty decent. The bar was low, but I think we got the underlying earnings growth of around 12%. Our full year number for calendar 2025 is about 11% earnings growth, and we think we are kind of on track to meet those. We have started to see in the last couple of weeks sort of earnings upgrades in the consumption space, notably in staples, in discretionary. And so I think the sentiment is starting to improve. When you look at the broader market, there are still more downgrades that have happened in the last 1 month since the GST announcements. Then we have seen upgrades, which means the net sentiment is still sort of in the red zone, wherein downgrades are more than upgrades. But incrementally in the last 1 month, we have seen consumption pockets, people raising numbers. We think there's still more to go there, and so we can start to see more upgrades in the consumption sector. And as I said, we think we should be able to achieve that sort of 11-12% earnings growth, which is what we have. We also did some deeper analysis around the GST cuts and the impact of that on corporate earnings, and our sense was that I mean, obviously, you have to make some assumptions in terms of how much demand elasticity in different sectors. But our sense is that in general, it could improve India's earnings by 1 percentage point. It sort of looks a bit low, but it's because it's concentrated in consumption, and large parts of the other markets do not really benefit from GST. But net, that should be accretive for underlying earnings. We haven't raised the numbers a lot because some of that gets shaved in because of lower growth on the infrastructure side and the continued uncertainty around tariffs. So net, we still think overall there is a net positive earnings impact from the GST overall for the market.
Hi, Sunil. Good to see you. When I remember exactly 12 months or so ago, we had quizzed you about the Chinese markets, and you said maybe the Chinese markets from 9.5 times could trade around 11.5 times as well. And that's what could cause them to, that index to do pretty well. And that's how it's played out, right, in the last 1 year. Indian markets, actually, MSCI India is struggling, while you have the MSCI Emerging Market Index that's done far better. So we have relatively underperformed. Give and take everything with the kind of action we have seen both on the fiscal and the monetary side. Do you think India gets to a stage now where we get back to market performance or maybe outperform? Point number one. And the second point is on the FI holding. They have been selling into the Indian markets non-stop. The holding in the Indian markets is the lowest we have seen in multiple years, and they're net short. Do you think it's reaching to a stage where we see that slow down a little bit at least?
Look, Nigel, I mean, you're exactly right. I think India is, depending on whether you look at MSCI India or Nifty and dollar or local returns, but India is flat to moderately down for the year. EM is up 25, 26 for the year. So you have sort of seen more than 20% underperformance for India. That's the largest underperformance India has seen on an annual basis in the last 30 years. So it's been a stark underperformance, and China has done much better. We were lucky in terms of our allocations that we were overweight China, we were overweight Korea. We downgraded India, as you may recall, back in October last year, so almost a year back. And so that relative call wherein China has outperformed, Chinese equities have outperformed Indian equities by almost 70 percentage points, has worked very well. So you're right in asking, and foreigners have sold, and are we at a point wherein some of the mean reversion can happen? I would say, look, I think the valuation premium has definitely come down. When China was at 9-10 times, India was at 24-23 times. You were looking at 100% plus premium. Today, that premium with China rallying and going to 15 times, with India being at 20 times, is sort of down to 30-40%. So we have seen a large compression in premium. But we do think And we are still overweight China. We think that momentum in China could extend for a couple of quarters. But at the same time, I think the catalyst for market rotation, so to speak, or India to outperform has to come in from not just valuation coming off a little bit, but underlying growth and earnings improving. I mean, we obviously have a real GDP growth of still 6.5, 6.7 is where our forecasts are. But inflation is running pretty low, so the nominal growth is still at 8 handle. We think next year that goes to around 10 times, which is similar to what it has been in the last few years. So this year, obviously, the nominal GDP has been unusually low. That, along with the fact that consumption recovers and some of the other sectors, especially financials, we think will recover with a couple of quarters of lag. I think that could cause the market to do a bit better. But in the near term, we still think that some of the other markets, including China and Korea as a case in point, might have a better momentum compared to India. I mean, FII flows, encouragingly in the last couple of weeks, have been turning positive. But we'll need to see if that trend sort of persists. We see that across the EM complex, wherein flows have generally been positive because of the macro tailwinds. And I think what we are seeing now is India is also benefiting a little bit from that.
No, absolutely. I mean, the last few years, right? I mean, the best performing markets have been India and the US. I think recency is a powerful thing. I expect every year to be a big one, but it's turned out to be quite okay. And we're in September, right? Still a couple of months to go before we close this one out. Sunil, so how does one position one's portfolio? Financials is clearly an area you like, but if you can, I mean, talk about your published sort of names, or you want to go as close to names as possible, segments where one should look for opportunities in a positional way now.
Yeah. Look, I mean, Prashant, I mean, we can't talk about individual names, as you know, but I mean, in terms of sectoral preferences and segments, as I mentioned before, even after the personal income tax cuts that we saw through, we already had positioned in terms of liking the consumption sectors or investment sectors. And so we are overweight staples that should benefit from the GST cuts. We are overweight autos. We do pick up some of the QSR and the tourism and the internet names through the overweight in the internet or the TMT sector in general. We also are overweight financials. So I think financials and consumer sectors are where we have our sort of most positive views on. On the other side of the ledger, we are underweight infrastructure, excluding defense, which is a structural theme, but the rest of the infrastructure pack, we are underweight pharma. And so we have a clear preference of consumption over investments there. We are neutral IT, realizing that it has come off a little bit, but we think it may be a little bit too early to position there. The only incremental change I would say we have made after the GST announcement in terms of our sectoral preferences has been around the cement sector, which may be a bit sort of anti-consensus in the sense that obviously there is a GST benefit specifically for the cement sector, but we also think that they may be able to sort of hold on to or improve their margins given the industry setup. And property sector in general is still looking pretty decent. And so the combination of sort of benefits from the GST cuts with pricing power within the cement sector could do better. But overall, I think those are the pockets which we think outperform within the broader market.
Got it, Sunil. That gives us a good framework, at least, but an overall view on how you're thinking and positioned on the market. Just a clarification, this 11% earnings growth that you spoke of, that's for calendar year 25 or is it for FY 26?
Surabhi, this is for calendar year 2025. And as I said, we are halfway through or more through the year. We'll see how the third quarter reporting numbers come up, but we should be able to we are in line with those numbers. Just to sort of put that in context, we haven't sort of changed those numbers or felt the need to change a lot of those numbers through the course of the year. Coming into the year when we had a more cautious view on growth slowdown, we were still at 11-12%, or roughly at 11%. I think consensus at that time was 16-17%. Consensus has come down to our numbers where we, through a lot of changes, did not feel much need to change those numbers. But we do expect earnings growth to further improve next year, as in calendar 2026, from current 11% estimate to around 14% estimate, as some of these growth recovery comes through. And we think market basically on a 12-month basis rides those underlying earnings growth with a bit of multiple sort of compression from current levels, given it still looks expensive relative to everything. And
yeah.
how we sort of get to.
No, I'm glad you brought up that point because I was just leading into that. So I'm just reiterating for the benefit of our viewers. So 11% earnings growth this calendar year, 14% earnings growth in the next calendar year, 2026. And that really brings us back to the central point, Sunil, right? It's all about earnings. The day these earnings start really firing up, we'll see the FBI's return. I mean, they'll take their tactical calls again vis-a-vis positioning and valuation. So this 14% growth that you're talking about for the next year, this primarily you expect will be driven by consumption and financials, right? And those are your key overweights.
Right.
So what makes you optimistic? I mean, I know I'm being a bit of a naysayer here or whatever, but it's just that we haven't seen a broad-based pickup in consumption in so many years. The market's been completely pivoted towards Capex. What will change? And the problem is that usually it's been wherever there are savings, it goes to a few discretionary stocks. It doesn't become a wide mass sectoral trend, right? So what makes you confident that that will change? It won't be just about 3 jewelry stocks and 2 real estate, stocks which go up on discretionary consumption.
You partly answered that question, Surabhi, there itself, because I think the pushback we were getting from investors, even during the recent marketing, is that, look, the GST cuts would be helpful, but does it sort of extend beyond a couple of quarters, and how sustainable could the pickup in the consumption be? So I would say make 2 points. One, I think the GST cut benefits come on top of the recovery we were already seeing in the roller cycle. And so we are already therefore seeing not just the high-end consumption doing better, but signs of pickup in the mass market consumption. And I think GST at the margin kind of reinforces or accelerates those trends. There is also the difference between the earlier sort of VAT cuts or even the personal income tax cuts that were announced back in the budget versus the GST cuts that we have been making, is that the exact point you made, that when you have personal income tax cuts, that only benefits a small cohort of the population, whereas the GST cuts are actually much more wider. Everybody kind of benefits given, and it's across different segments. And so we think the impact of the GST cuts should be far wider than we have seen from personal income tax cuts, which obviously was a smaller segment, but also some of that was used in deleveraging household balance sheets. And this one we think should help a lot of the consumption categories. There's also a difference that in the previous instances of VAT cuts, you always had the entry for profiteering law, which means the companies had to fully pass that through. This time around, that's not there. So we think companies have more degrees of freedom in terms of how they pass these GST benefits, and in terms of price point packs and grammages increasing in the sense of higher volumes. In some cases, you do pick unorganized to organized shifts, and so you get some sort of premiumization come through. In some cases, you have better pricing power, and so you may be able to only sort of retain some of the margins. In some cases, you were already spending on marketing and expenses, and so with the cuts now, GST cuts, you may be able to retain, not spend as much, and that's expansion. So a variety of models, I think there could be sustainable growth, a boost from the GST.
Okay, and that explains why you are so optimistic on consumption, not a small, narrow part of it, but, a pretty wide basket of the Indian consumer. Thanks very much, Sunil. Great conversation as always. You have a good rest of the day, and of course, we'll see you again soon. For the time being, it's time to put the spotlight on corporate conversation. And we have Mr. Vimal Kejriwal, Managing Director and CEO at KEC International, joining in. Mr. Kejriwal, always a pleasure to have you in. So much to discuss, as usual, on the business, on the sector. So let me distill this for our viewers in terms of 3 key highlight areas that we want to focus on. Of course, we want to understand the impact of the GST cuts on your business. I mean, of course, entirely B2B, but how does it play out? Is there any implication? There's some concern in the market whether the government's pivot towards consumption, whether that means lower Capex. So then are orders at risk? And finally, again, GST related, EPC contracts are going to be taxed at 18%. So what does that mean? Let's understand and find out. So Mr. Kejriwal, it's all GST related, right? Step by step. So let's start with your first interpretation on these EPC contracts being at 18%. And overall, I mean, it's all a pass-through. I guess you get input tax credit for everything. But is there any change, positive or negative, from your lens?
Surabhi, good morning. See, first of all, almost I'll say every contract of ours was at 18%. what has happened from 12 to 18 is small contracts which were very, very, I'll say, labor intensive with a lot of sand supplies, other items which were at a much lower taxation. So there were very few contracts. At least I don't think we had any contract at 12%. So it effectively does not apply to us or to any of the large contractors that the GST change from 12 to 18 applies. I don't think it applies to, at least I have looked at all my contracts, it does not apply to any one of them. We didn't have anything at 12, number one. Number two, I think the major benefit for us in the GST change would be on the duty reduction on cement, which would help us on the inverted duty structure. Today, if you look at my balance sheet, we have got close to around 500 crores lying on GST input credit. And most of it has been happening because we have been paying a higher duty on the input and we've not been able to set it off. Now that the duty on cement has come down, and which is where our major input credit reversal was pending, that would definitely help. One is on the balance sheet side. Second is also on the cash flow side. Now that you will end up paying 10% less on the cement procurement, I think that's one major item which I'm saying. Third piece which I think we can see is that with the reduction on duty on the solar side, there could be some better economics on the solar side for the developer and resulting into better economics for the EPC. I think very broadly those are the impacts of GST for us.
Okay, so maybe more solar orders as they have a lesser tax burden now.
Yeah.
The EPC change doesn't affect you because you were already at 18%, and cement obviously is a big boost. On cement, I mean, just to follow up, since it's a big saving, right? It's 10% saving. So what does that mean? Should we expect some of that to flow through the margins anyway? This year you've been guiding for margins to improve to 8%. So how are you going to digest the savings on cement?
So Surabhi, that 8% is on EBITDA level. So whatever savings we'll have would be on the interest side. Because cost mate will not make any difference to us because the GST was in any case billable to the customer. So it is only a cash flow impact for us. Where there could be slight changes on cost structure would be items which were not billing to the customer. Let's say whatever we were spending on the stores and everything else which is there on the consumable side. There may be a marginal impact, but I still don't see that as a major driver for margin correction. But interest can get impacted positively. And also now with what's happening with whatever RBI has been talking with the Fed cut yesterday night, I think there could be some improvement on the below the EBITDA lines.
Okay. So basically some savings on interest costs perhaps. That would of course flow into earnings, so it will be good news for your shareholders. So the other concern, and this is a wider debate though, I mean the finance minister in her response to that question, when we had that conversation with her, she was very committed to Capex. She said, whatever I've committed in the budget on Capex, we are not pushing back or pulling back from that at all because of the GST cuts. But still there is this, chatter that the government's focus is now consumption. So maybe it starts having some impact on order flows, different segments, water, power, etc. Your thoughts?
I think irrespective of the GST cut, we have seen an impact, at least on the water side. There's hardly any funding happening on the water projects. And then that's a big setback. One is the cash is not coming for the existing contracts. And I think the number of orders which are coming on water side have also slowed down. So that's one impact. As I said, with or without GST, we have already seen a significant slowdown on the water cash flows, especially from the central side. Okay, center is actually nudging states that you need to do better work on the execution and you need to take a better control and payment and all that. But somehow with the state finances, that's not happening. So water is definitely one subject which I think is getting impacted on this. Power, if you look at it, was not it was largely independent of the government financing. Power Grid or NTPC and all that, they have been raising their own money and then they have been funding their projects. So I do not see any major negative on the power projects because of the impact of the cut or the government finances tightening. On the other hand, I think with the interest rates going down, that could have a positive impact on the government financings.
All right. Hi, Mr. Kejriwal. Good to see you, Ben. So what about collections? The last time around you had mentioned that collections in various sectors, water as well was one of them that you said collections were a little bit slower. Has the situation improved?
For water, it has not improved. Let's be very honest. I don't think we have seen any major improvement happening on the water side. I think there's still a little bit of a tug of war between the center and the states as to who will fund what. And I think that's where we are having a problem. But on all other sectors, I don't think we have seen any payment issue. No.
Okay. All right. Tell us, what is the order inflow, sir? As of Q2, what is that number at? And for the year, what are you gunning for?
So as of now, our order intake has been roughly close to 9,000. I think 8,900 or something like that has been the inflow. We have a large L1 position. We do expect a significant conversion to happen by 30th September. Our target for the year is around 30,000 crores. Last year, we did roughly 25. So we are hopeful that we should be able to improve it by 20% and reach 30,000 crores.
All right, so we've got a date then before the end of September itself, because that L1 position, you're optimistic that it gets closed out. But give us some idea about the size of it. Close to 9,000 crores of order inflow so far. For the year, expecting it at around 30,000 crores. But this L1, that's a joke on the pack, it seems. How large is it?
So right now, it's around roughly, I think around 6,500, 7,000 crores is the L1 today. Largely, I'll say in transmission, a little bit in civil and railways also. But we expect that most of it, not most of it, at least some part of it would get converted before 30th September. So we should have an order intake coming into 3,000-4,000 crores by 30th September further.
All right. And final question from my end for FY26. How are things looking? I think earlier when we were talking about it for the outlook for the year, revenue growth, I think, was in mid-teens, around 15% is what you're talking about. Margins in that vicinity of around 8.5%, and some debt reduction as well. So revise all those three numbers for us.
So the first two remain where they are, that at 15% or so of growth and margins between 8 to 8.5. Debt, I think the water is still worrying me. I'm not sure how much debt will go down, but I think the interest rate scenario is becoming benign, both in India and international. And I think we are around 30-35% of our debt is in foreign currency now with the Fed rate cut happening. I think on that part of the numbers, I think we should see some improvement happening below the line, below the bottom.
Mr. Kejriwal, before we let you go, I just want to go back to that point on water. So my question to you was more in terms of awards. This whole debate between government focusing on consumption versus Capex. So when you say that financing from the center side is going down for water, and that's an ongoing issue. I mean, you've been explaining that to us, that the onus is on the center, wants the onus to be shifted to the states, so they can start financing and clearing the dues as well. But in terms of awards, whether it is the water segment, whether it is power you've already mentioned, or even the railway segment for that matter, do you sense that the awarding activity could slow down at all over the next couple of quarters?
So I don't think a slowdown will happen in the power side. Railway, I think, has been a bit of a issue for all the larger contractors except for the bullet train. So I think if you see, most of the larger contractors are not getting any railway contracts. Okay, execution is a serious challenge on the railway side. As far as water is concerned, what is happening, Surabhi, is that one is I'll say the tendering has slowed down because of the funding issues. Today, if the government does not, the state does not know whether central will fund them or not, I think they are very apprehensive of floating new tenders. Secondly, whatever tenders come, like if you ask me, I have not won, or maybe probably have not even bid for a single water tender in the last 2 years. Even if the tenders are there, I think it's not a market where we are there till today, unless and until the cash flows improve and the backlogs get cleared. I think that's the point I was making.
But that makes perfect sense. Unless the cash flow situation improves, collections start improving, I mean, fresh bids will get impacted. On railways, you said you're expecting more slowdown in railway awards as well?
So I don't think the railway awards will slow down. I think the issue on railway side has still been on the execution front, where because of, let's say, blockages, blocks and all that you require, execution on railway projects has always been a pretty slow affair. And because of which, we have seen, many large players getting out of the typical railway EPC contracts.
Right.
However, last 2 years, the focus had been more on the customer side, where new trains and stations and all that. Now we are seeing a change happening, and a lot more tenders are coming out for new railway lines, etc. So I think railway, the tendering has definitely increased from before.
Absolutely, and I think you've been, Mr. Kejriwal, you've been telling us that you've been a little cautious on the railway side on your own part, as some of the other bigger players as well. Thank you very much for joining us. It's a pleasure having you here on CNBC-TV18. Thank you. 90 points on the Nifty, 25,420. Have to mention Poonawalla Fin. Poonawalla is up 11%.
Wow.
It was not there in the morning when we started, but it's in the mix now. And how? Look at that. That's a 50 rupee move. It's the #1 volume-led gainer on the NSE. So that is Poonawalla. There is IRM Energy. It's 372. It's 13% higher on IRM Energy. And #2 in terms of volume-led gainers. And there is Newgen. Newgen is up 7%. Actually, all three were not there in the mix in the morning when we opened. But Newgen is in the #3 spot. Price and volumes, 943 on Newgen. And look at the volumes take off on that one. Actually, there's lots of new stuff which has come through. Zentech, etc. I mentioned, but there is Sonata Software, which is up 6%. There's a big jump. The L&T, Mindtree and LTTS, both are up 3% apiece as we stand. IOL Chemicals is up about 4%. So this is a new list now. The initial sort of, pop mostly is all flipped to newer and newer names, which means that the breadth is also expanded. In 90 points on the Nifty, we take a quick commercial break here. We have the management of GE Shipping joining us on the other side. Stay tuned.
Welcome back. This is Corporate Radar, and as promised, let's shift focus to GE Shipping. Now, the company has recently sold, a 2005-built Suez Max crude tanker, and also has planned 2 fleet acquisitions in Q2. We have with us Mr. G. Shivkumar, the Executive Director and the CFO at the shipping company. Hi, sir. Good morning. Thanks a lot for joining in. Well, we're coming to you in just a bit, but for now, just highlighting the 3 big talking points that we're going to be looking at. There have been multiple sale purchases of contracts for vessels. Point number 2 is the current business landscape and the spot rates. And point number 3, changes due to the geopolitical developments and how things are panning out on that front. So lots to discuss. Let's get straight to the action then. Mr. Shivkumar, always a pleasure, sir, having you on the show. Lots to talk about, so let's get straight to the point. 3 ships have been purchased, 1 ship has been sold. How are the asset prices for the new as well as the older ships? And are there any plans on conducting more such activities, that is, buying or selling some of these ships? Do you have some kind of outlook in the near future?
Morning, Nigel. Thanks for having me. Yes, we've currently contracted for purchase of 3 second-hand vessels, 2 bulk carriers and 1 Suezmax crude tanker. And we have contracted for sale of our oldest crude tanker as well. These transactions, and this is what we've been doing over the past 2 years, prices have been significantly higher than our comfort levels. And therefore, we've been focusing only on maintaining capacity, not doing capacity expansion. So we've been selling older, less efficient, less desirable vessels and moving them to similar types of vessels which are younger or more marketable. So that's what we've been doing. For instance, you'll see we sold a 2005-built Suezmax and we bought a 2010 built Suezmax. So what we're doing is we're extending the runway till we can get the market prices that make us comfortable to do a significant expansion.
Okay. All right. So, Mr. Sivkumar, just to get this clear, obviously the older vessels, they'll be, calling for higher OPEX, higher amount of spends as well, and profitability could be relatively less. That's why you're looking at getting in the new set of vessels. Is that correct?
OPEX, not so much. There is sometimes maintenance Capex, which is higher. However, what happens is on the revenue side, because they are less freely tradable beyond a certain age, and therefore we'd like to have our ships freely tradable to maximize revenues. It's more on the revenue side than on the cost side, really, so that we can maximize revenues by having the maximum optionality for trading those ships in the international spot market.
Okay. All right. Give us some more color then. How are the new vessel additions, sales expected to affect the company? Say the revenues, the margins, the NAV as well. If you could give us some kind of insight.
No change really in the NAV because we're buying them at market, and we're capturing part of the NAV gain by selling the older vessel. So we'll book a profit on sale on the old ship that we sold. In terms of revenues, yes, the capacity goes up, but finally for us, it's the rates which have the bigger impact on revenues. The capacity, of course, is a factor, but the significant swing factor here are the rates. These capacity changes, we're talking about 3 ships, of which 2 are incremental. It's not huge. It's on a 40-ship fleet. It's 5%. The rates move by 10, 20% in a week. So that's really the big factor that moves revenues.
Yeah. Mr. Shivkumar, what's the net? Good morning, Prashant here. What's the net outflow because of these transactions?
This would be a net outflow probably in the region of $60 to $70 million, something like that. $60 to $75 million.
$60 to $70 million is the net outflow after these, because of these transactions. And you fund this how, and what's the cash levels post this?
Yeah, so we have about $800 million in cash currently. So we'll just fund it out of cash for now. We'll be using cash to fund, a lot of our expansions before we go into taking debt, really, because there's so much cash sitting there. We might as well use the cash before we really draw down any debt.
Okay, so you're using basically about 10% of it.
That's right, less than 10% of
less than 10% of your exit. And are you doing this for many more, or are you done with these vessel swaps? In that sense,
I think 8 or 9 of these transactions so far. We would be looking to do some more. We're always looking at these opportunities to do some modernization of the fleet. And if we get any transactions that make sense, we will do those. But again, mostly we'll be doing just the switches, which is you sell an older vessel and get into a newer or a better spec vessel.
Give us a sense of how business is across segments now, Mr. Shivkumar, now compared to, say, we left off at the end of the last quarter.
That's right. So the one significant thing which has happened in the markets, in the crude tanker market specifically, is that OPEC came back with more oil into the market starting from May, June. That's starting to have an impact on crude tanker markets now, which is basically you're having more oil that is being transported, which means you need more ships. So the rates for the large crude tankers have gone up a lot in the last 2 weeks. We don't have the VLCCs, which are the 2 million barrel ships. So those have gone up to, I think, $80,000 a day from maybe $30,000 to $40,000 a day 2 to 3 weeks ago. And those typically are the most sensitive to OPEC oil production and OPEC exports. It hasn't filtered through to the other sectors, a little bit to the Suezmaxes that we operate. So those also have gone up. Net, we are about at the same levels as last year, a little bit better, maybe a few $1,000s better than we were 2 to 3 months ago in terms of spot rates for Suezmax tankers. For Aframaxes, it's much of a muchness. For MR tankers, we are probably better off by 1 to 2,000. And again, MR tankers is That's the sector where we have maximum exposure. We run 12 ships in that sector. Those rates are up by about $1,000 to $2,000 a day compared to where they were a couple of months ago. Coming to dry bulk, we've had a surprisingly strong market, mainly on account of, and Nigel mentioned geopolitics, possibly on account of some front loading of grain imports by China, soybean imports by China. We've had the smaller ships having a pretty strong market over the last 2 to 3 months. Basically, the US grain season starts in October, the soybean season. And I think they've been stocking up, the Chinese importers have been stocking up from Brazil and Argentina, preparing for a situation where tariffs may make that grain unaffordable.
Point taken, Mr. Shivkumar. That's a pretty comprehensive sort of picture that you draw out. So all told, I mean, at a company level, what does this mean? I mean, as we progress through the quarter, where does it leave us?
Currently, where the rates are sort of net around where they were a year ago.
Okay.
Maybe marginally better than the previous quarter for some tanker sectors, but not very different. So prices are pretty high. Prices of ships are pretty high, and that's why we are not doing any significant expansion. So we are still waiting for those opportunities. So for now, it's a holding operation. We make significant cash flows at these rates, significant free cash flows at this rate. We are still really collecting the cash and waiting for the market to give us the opportunities and the prices to buy.
Always a pleasure, sir, having you on the show. Thanks a lot for joining in. Post your Q2 numbers. We'll re-invite you, and maybe we'll try to pull out some numbers as well from you. Wishing you a good day ahead.
Thank you.
Well, I think the street likes actually what Mr. Shivkumar had to say. I think the stock was more or less flattish. It's seen a bit of an up move in the last few minutes or so. So keep an eye out on the bottom of your screen. Those are the important takeaways. Let's get in Vijay Rajani, though, Senior Technical and Derivative Analyst at HDFC Securities, who's back on the show. Hi, Vijay. Thanks a lot for joining in. What's your call on the index? You know, a good 1,000-point rally is what we have seen in a matter of a few trading sessions, after underperforming, mind you. But now the Nifty Bank is on a winning streak. The Nifty is up, I think, 11 out of 13 trading sessions, taking today into account as well, 12 out of 14 trading sessions. Good for more? Or do you think now you get to a stage where you see some kind of consolidation, some kind of a near-term hurdle? And also fill us in with a couple of your stocks.
Yeah, good morning. So definitely the overall trend has been positive and the continuation of an uptrend is there. There was a breakout around 24,900 where we saw a trend line breakout, and after that continuous participation is there from the different sectors. So the way sector rotation is happening, it looks like that market should continue to do well and it will continue to extend the rally which has started from the recent low of 24,800. So yesterday we saw that Nifty also surpassed the crucial resistance of 25,250, which was the previous swing high. The immediate resistance I see is around 25,550, which was also swing high registered in the month of July. So right now, the best strategy for the trader in the Nifty should be the trailing stop loss. And as of now, according to us, 25,250, which happens to be the previous swing high and resistance, now it will act as a support. So 25,250 should be the trailing stop loss right now, and we can expect some higher levels from this level. And the way sector rotation is happening, like many sectors have still not participated in the market, like IT, real estate. These are the sectors, then capital goods, some of the PSU stocks. So many sectors have already done well and many sectors are yet to do well. So I think participation will come and short covering will come from them. FIs are still holding much short position in their index future position. So we can expect further short covering from them. So we are bullish on the market right now. 25,550 is the immediate resistance and followed by 25,670, which was the swing high resistance. So yes, one can continue to hold on to the long position with the stop loss of 250.
Okay, all right. What about individual stocks?
Yeah, so today IT stocks have participated well since morning. Some gap up opening is there, and I still see upside from the this particular sector and participation. So Infosys, the large cap IT stock, looks good to me. For 1550 is the level one can go along around this level. 1520 should be the trading stop loss on the upside. We can expect a target of 1595. The second pick I would choose from the capital market segment. Yesterday, CAMS did very well, and today we can see some other stocks participating in this sector. So CDSL has given a fresh breakout on the chart. So capital market theme can work out for a couple of days at least. So CDSL around 16101 can go long. I would suggest a trading stop loss at 1585. On the upside, I'm expecting a target of 1650. So Infosys and CDSL on the long side with the mentioned sort of place, stop losses.
All right. Vinay, good to get those particular trades. By the way, you've got this massive move in Poonawalla today, Vinay.
Yeah.
And I think it's coming up to the highs of whatever, 520 or so, I think was the high. Any thoughts here?
Yeah, so it is a very good breakout with the volumes, and NBFC space has been doing quite well. We saw that Bajaj Finance, Finso, and the last session in the last show which we did, we recommended Chola Finance, and today Poonawalla Finance has participated. So the primary trend was up. It was into consolidation. Now today's move gives lead to the resumption of a primary uptrend. So it is a clear-cut breakout on the chart. The immediate support we can say short-term for the trader is around 475. That should be kept as a stop loss. And yes, we can expect some higher level. 520 is the all-time high level I can see on the chart. So yes, there is a good chance that it will surpass that level and do well in the coming days.
All right, Vinay, thank you very much for that. So those are some trades, and that's a view on Poonawalla Fin Corp. But I think Gaurav is standing by now on Poonawalla Fin Corp. Gaurav, tell us more. Morning.
Whereas fundamentally, if you look at Poonawalla Fin Corp, the thing which is supporting the stock right now is the capital infusion. Now, the promoter has infused around 1,500 crores in the business. Earlier on 25th of July, during Q1 results, they had already announced that the board has approved this infusion, and now they have gone ahead with the infusion. If you look at the stake now, the stake of the promoter has gone up from 62.4% to around 64%, and after that, there are other different changes as well. The book value per share now. This is going to be a value accretive. The book value per share will go up almost by 13.4% because of the stake increase. And let's also not forget that this is also during the time we also have second quarter's results which are coming in a few days. So definitely timing is also something which is positively working for the stock. Remember, yesterday the stock was trading in the range of 440 and this fund infusion has happened at a cost of around 452.5. So definitely that is also something which is positive. And as a result, we are seeing a sharp uptick in this counter.
Okay, all right, Gaurav, thanks a lot for that. Clearly, the stock up and about, up close to around 10% as we speak. I'll tell you what, we'll slip into a short break. You come back, Manisha Gupta is waiting for us on the other side. She'll tell us what's going on in the commodity markets. Don't go anywhere.
Welcome back. It's time to talk commodities. We have Manisha in the house to tell us how the commodity markets have taken into that 25 basis points rate cut. Manisha.
Well, thank you for that. You know, it was a huge run-up that we saw in many of these metals. The open interest was also increasing. The buy call was there. There were no sellers in the market. But now that the event is done with, we are looking at some sigh of relief and some profit-taking as well. And the US Fed has signaled 2 more rate cuts as labor market weakens. There also was a statement, various statements, by the way, from Powell. But one thing that the market seem to be hinging on right now is that Fed is in a meeting-by-meeting situation regarding interest rate outlook. So that's what the street is looking for. So it still is a bit of a suspense as we go forward from here. If you look at the gold prices, then we did see a record high as soon as that 25 basis point rate was cut. We saw an all-time high of $3,704 an ounce, and then there was a big profit taking that you saw in the overnight markets. We saw gold declining all the way to $3,660 an ounce as well, and that's exactly where it seems to be trading right now. So while gold was down 1%, we saw silver down 2%. 2.5% of a decline is what platinum also put on table, and copper fell by 1.5%. So there was a sigh of relief. There was finally some profit taking with the event now done, and the markets reading into the statements there. But when it comes to gold, and with the kind of uncertainty that we are in right now, with expectation of more rate cuts and the central bank buying and the de-dollarization theme, most of the banks still believe that you're looking at higher gold prices going forward. Commerce Bank report came yesterday, 3,600 of an average in this year, 3,800 of an average in 2026. Deutsche Bank report also says that $4,000 an ounce of an average price is what they're looking at in 2026. So very bullish Q still continuing from banks. Goldman Sachs is talked about $5,000 an ounce in an event that you see treasuries move in case of gold. Even a 1% move could take the prices on the higher side. The other one that I want to talk about is copper. And here as well, we've seen profit taking coming in, but not for too long, because the markets believe that you are looking at demand going higher. At this point in time, it also has to do with supplies, though, because Chile expects national output to increase going forward. They're expecting a 6 million tons of a record production by 2027. It's not just Chile, by the way. The state-run Codelco in the month of July has seen an increase of around 6.4% in sense of production. And BHP's Escondida is also talking about 7.8% of an increase. So immediate supply increase is what the street seems to be working with right now. And the China announcing 5% of a decline in production in September till time really seems to have been nulled by this. So with major moves done, the markets do anticipate there could be some consolidation today and tomorrow before we start seeing buying come back in for many of these metals.
All right, Manisha, thank you very much for that. Interesting as always. Well, we are coming back after a quick break. It's the JP Morgan conference curtain raiser. Latha in conversation with Sajid Chinoy and Sanjay Mukim. So we've got the economy and equities both covered. Take a break and see you on the other side.
A Fed rate cut has just been announced and 2 more are likely this year. In India, a massive indirect tax cut, GST cut, goes into effect on Monday. More rate cuts in India too may come. To parse the impact of so many tumultuous changes on Indian markets and macros, the JP Morgan Brain Trust is with me. Sanjay Mukim, the head of India Equity Research, and Sajid Chinoy, head of Asia Economic Research, JP Morgan. Welcome, guys. What a great time to have your JP Morgan 10th Annual Investor Summit. I mean, such a crucible of changes. Sanjay, therefore, to start with you, September 22nd, your conference day coincides with the GST cut going into effect. So I just wanted to ask you, you all must have parsed the impact by now. Yep. After the Q1 earnings, you may have a forecast. Have you upped or changed any earnings?
We haven't yet, and it's great to be on. Thank you for having us, Lata. So it was not by design that September 20th. That's a week we do it every year. Okay. But I would argue to that point you made that expectations in India have actually been cut, quite a bit, and quite early in the fiscal year. So normally what you get, typical sell-side behavior, is that earnings are cut towards the second half. When nobody cuts earnings in the first quarter because, there's 9 months to go and we'll wait it out. But because we've got such cautious feedback from corporate India in general, that there's been a significant amount of earnings cuts in the 1 quarter already in the year. And therefore, you're starting off the second half with a very supportive pace. And while it's still early days to say how much of an upgrade or if we get upgrades at all, but the base for earnings now looks far more favorable. Whereas on the other side, you've got the support to consumption from the tax cuts in February and these GST cuts which have come through. And of course, remember that the Indian market has got far more interest or far more representation on consumer-facing companies than Capex-facing companies.
Yes.
So overall, you are likely to see support to earnings. Expectations being low is a good start for looking at equity.
But has it pushed you overweight on, anything, consumption, discretionary, financials?
We are overweight, India in the EM context, and we are overweight discretionary in India as well. Okay. Right? Because there is a clear shift in policy preference to try and drive the consumer part of the economy a little out of the rut it has been in, let's say, for a few years.
I have lots to ask Sajid on consumption, but before that, the big event that is just behind us, the Fed rate cut. From an India standpoint and from a global growth standpoint, what are the takeaways?
So a couple of things, Lata. First, the 25 base point cut was no surprise. I think 2 things I was looking at was that it was important that there was only one dovish dissent, which was Miran. So 2 governors, as we know previously, voted with the consensus. And that actually is the more important takeaway, that the independence of the Fed is being prioritized more than personal ambition. I think that's an important takeaway.
And that's why the dollar didn't fall further.
Exactly. So you had both, Bowman and Waller, who had previously voted against the consensus, now joining the consensus to say the Fed's very much behind their chairman. The other takeaway for me was that the chairman described this cut as being an insurance cut. And that's not a surprise because we've been arguing for a long time that tariffs and immigration are both stagflationary shocks. They simultaneously hurt growth and push up inflation. So the Fed did this dilemma at this point where the labor market has slowed meaningfully, and the worry is that the US may slip into recession, but at the same time, core inflation is firming and firming and firming. Exactly. So the way we see it is if the labor market were to crack, then the Fed will have a very long easing cycle, no matter where inflation is, because they will presume that a recession is very disinflationary. But if the labor market, if this is a head fake, and the labor market stabilizes, it's important to realize that the break-even rate may be lower in the US now because of all the anti-immigration efforts. Okay. If this is a head fake and the labor market stabilizes, then this could be a much shorter easing cycle because this is purely insurance. Okay. The implication for EMs is not very much. The point is, unlike previous cycles, the dollar has weakened so much in the run-up to the Fed meeting over the last 6 months. That's what matters for EM central banks. So even without the Fed moving, in the last few months in Asia, for example, we've seen a series of cuts across the board. Thailand, Indonesia, Korea, India, the Philippines. So EMs now don't need to wait for the Fed necessarily in the wake of a weaker dollar.
A serious Asian disinflation. I'll come to that. I tend to get carried away by these topics. But, the one question I would have asked Sajid, nominal GDP. While the real GDP is very good at 7.8, reminiscent of the 2004 times, at 8.8, does that, impinge on you when you are doing an earnings growth forecast?
It will. And this is something that we've been highlighting to our clients as well. If you roll back, Lata, let's say to FY23, there were several quarters where nominal GDP growth was north of 20%.
Yes.
And when that happens, your 1,000 stocks in the market, the median growth will be high double digits, right? And everything looks great, and you straight line those growth forecasts, you double the multiple, and the market's a multi-bagger. Now, we are single-digit nominal growth, and we will probably stay around the vicinity of 10% for the next 3 years. So we'll have this fallacy of composition in equity earnings forecast, because every analyst will bottom up say, my company can grow 15%, but with the nominal GDP at 9, 10, only a handful of companies will deliver double-digit growth, right? The median growth of earnings in the market will be a multiple of that 10%, probably a low multiple, right? And therefore, we will have this phenomena where growth from corporate India will get concentrated into the few that can deliver double-digit growth. In our framework, the ones that deliver growth will still command those premiums and will still command the multiples, but investors will need to be careful in assuming that almost everything under the sun will have double-digit growth because it is India.
Oh, absolutely. But Sajid, what is the inflation trajectory for India itself? Because the GST cut will take away a little bit from prices. But the RBI had forecast 4.9 as 12-month ahead for the second quarter next year.
So inflation is very benign even without factoring in the GST cuts. If you look at the full year as a whole, because each quarter will change. FY26, year ending March 26, our average is 2.8%.
That's the market consensus.
Extremely soft. Now, if you add on to that some fraction of the GST cuts, I mean, the RBI should look to the GST cuts. These are one-time price changes. This isn't disinflation. But you're looking at about, 3%. I think the issue for the RBI is that we've already kind of bottomed out. And if you look forward, base effects have an important role to play. Base effects depressed inflation this year in the middle of the year. Base effects will push up inflation in the first half of the year. First quarter looks above 4%. Second quarter could be close to 5%, but that's coming on a base that was 3% in this year. So you have to average these things out. So I think inflation for the RBI is not the issue right now. I think from the central bank's perspective, I would think that they have front-loaded their easing. They're very focused now on monetary policy transmission. We're seeing good transmission in the banking sector on fresh loans. Bond yields have gone the other way, but financial conditions more generally are easy. And I would say that if the Trump tariff shock persists, my own advice is to take a more surgical approach. This is a sectoral hit on certain sectors. We have an example from COVID before. When there's a sudden demand shutdown, we know what to do. And I think a combination of liquidity support, regulatory forbearance, and targeted fiscal support, I think, will be more efficacious, even as the RBI waits to see how things pan out globally and domestically and holds its any gunpowder
very
for the
quickly,
future.
Rate cut October?
Not in October.
But you expect one more?
Well, I think it'll depend because 30 seconds, Lata, you've got the headwinds of the Trump tariffs, which are very clear, but you've also got some building domestic tailwinds in terms of higher consumption, monetary easing, direct tax cuts, indirect tax cuts, lower inflation, good monsoon. So the RBI and a good, strong GDP print. I think the RBI will wait and see, like the Fed, how is growth panning out? Low inflation allows the RBI to cut in the future, but they'll want to see what the growth trajectory looks like.
Fair point. But, how is the FII interest in your conference? Because we are so clearly the underperformers. Is it reflecting in interest?
Interest is very strong, Lata. And I was worried...
Ulta. Okay.
Ulta. I was worried that given the market's been flat and other parts of EM are actually doing well, that you might see subdued participation this year. This is the 10th conference we're doing consecutively. It's the 80th year for JP Morgan in India as a firm. This is the strongest ever, the largest ever conference we've organized. We have 1,200 participants coming in. We are overwhelmed by the vote of confidence that we've got from our client sets. And again, content-wise, participation-wise, there is absolutely no sign of any waning of interest in Indian equities from both domestics, of course, but even foreign investors.
What are investors waiting for? What are the highlights, if I may ask?
I think let's think of the setup for Indian equities as well. The underperformance has been very stark, especially if you measure it in dollar terms. It's north of 20% YTD. Okay, on multiples, India is now trading at, let's say, a 10% discount to the S&P. Now, we've written research on this quite often to say that India's multiple tends to track S&P more than it tracks EM. So I said earlier, our earnings have already been cut, so expectations have been right-sized to a degree, and we are trading at a 10% discount. And now we've got these domestic catalysts that Sajid has talked about. So the setup looks great for a bit of a catch-up.
The inflection.
That's right. And what people are waiting for is signs of that inflection. So everybody is here to talk to corporates, to talk to people on the ground, to figure out, are we seeing any now, or are we likely to see any during Diwali or in the December quarter, right? So to build confidence in what is currently theoretical, but likely to happen, I think that's what's driving everybody to participate.
And you have a lot of corporates representative of consumption.
That's right.
Okay, just a word on financials. Sajid says at some point in time there can be one more cut, and that's kind of the feeling I'm getting, that no, people are not expecting in October, but they see the space. So does that make financials still something you're worried, not financial so much as banks, because there'll be more margin pressure?
Yes.
Or are you happy that they will be seeing credit growth?
So it's two stories there, Latha. One, of course, is that there will be margin pressure. And the charts are very, very clear. Lower rates do drive NIMs for most large banks down. Okay, it becomes difficult to manage that. However, the hope is that that is the catalyst that drives further lending into the economy, right? If you do the math on how much it now costs you to buy an entry-level car, right? So you build in the GST cut, and you build in the lower rates, and you look at the delta in the EMI a middle-income family has to pay to buy their first car. That's a very material delta on the loan.
Yes.
Right? And therefore, the argument is that all of these are significant changes and should be a catalyst for volumes. So yes, the margin comes under pressure, but the hope is that over the next 2 or 3 years, for the bank's financials, the volume outlook starts to improve as a consequence of what is happening.
Okay.
And that should therefore be good for the sector.
You know, I spoke to Dixon a few days ago, and they are so bullish on, you know, a 10% fall in the price of a 32-inch plus television, according to them, is going to make a very big difference. But, you know, I have to run into a break. Give me just 2 numbers. What is your GDP growth for this year, nominal and real?
Yeah, so I think real will be somewhere in 6.5 and 7.
Really?
Because on the back of a nearly 8% first quarter.
Real GDP 6.5
to 7. Nominal could be between 8 and 9. And therefore, it's important for investors, when they look at nominal variables, credit growth, GST collections, tax collections, we have to be realistic. It's not possible to get 13, 14% credit growth if nominal is going to be 8 or 9. That has to be your anchor on which you forecast earnings, credit, taxes, GST collection, which could be high single digits or very low double digits.
Okay, well, actually, even now, although the credit growth is 9.9 or whatever, under 10, if you count the bond market borrowings, then credit to the commercial sector is 13%. So probably we are managing 1.5x credit growth for the kind of nominal GDP. But quick break, I have more questions for you all. We are back. Bazaar viewers, you will get Chartbusters, but we will play the entire show after market hours.